Taylor with eXp Realty in Kingston, Ontario, and on this episode of LT Talks RE, we are going to talk build or construction loans. Well, I don't know what it's called normally, but with Karen Matthey from Mortgage Professionals. So, build loans, construction loans are quite a bit different than a regular mortgage, and I just wanted to go through the process from start to finish. When does somebody come to see you? When, what do they need to do when? So I guess we start from the beginning. At what point, if somebody is considering buying a lot to build a home, should they come in and see a lender?
Mm-hmm. So for sure. So the starting process, I think, is before they go to see a bunch of lots, is to get an understanding of the process itself. What are the types of things they're looking for? What are the documents? What's their financial picture look like? So I would speak to a client first, walk them through what a construction mortgage looks like, what the process is. I would take their application, I would take some documents, the standard type of documents we might look at for any mortgage application, but I would look to apply them specifically to a construction mortgage situation. It's a little bit of chicken and egg though, because I don't know the amount of the lot or the amount of the build yet, which can vary a lot depending on what you're looking at. So the first step is, yes, to come and see me, to walk through, at least understand the process, and to understand what some of the financing numbers look like, and maybe make some estimates, estimate what the lot might be and what the build is. And then to go to see you, to go see lots and look at some numbers.
Okay, so once they've got an idea of what the process is, and it can be a lot of a process. We are doing it right now, and it's a lot different, right? So maybe some people have already bought a house, they've done the mortgage, they might not realize all that goes into it. So once they've come to see you, got a good sense of what is involved, then they can start looking at lots. So okay, so now they've purchased their lot. What is that going to mean for the loan that they get? So say they buy a lot for $200,000. What is that going to mean in terms of moving forward with the loan process and the build process?
So one of the things I'm going to explain to them in our initial call is they need to have the funds or financing to buy the lot free and clear, which means if they're looking at a lot for $200,000, they have to have $200,000 to purchase that lot. Now, there is a possibility they can finance a portion of that lot as long as they have the ability to repay it prior to the build being started. So what some people do is they buy a lot years before they might build, and they may get a mortgage or a line of credit on about half of the value of the lot, is what's standard in sort of land-based mortgages, and then they work over time to pay that off as aggressively as they can. We also have scenarios where people have inherited lots, or parents have severed and they've provided that lot onto their children, or in the example we started with, somebody buys a lot for cash. So now they own the lot. The next step after that is to look at what the build is going to look like. So there kind of tends to be two routes people go with. They either go to a contractor or builder, and they get a contract to build the entire house, and that includes pretty much everything. That builder or contractor is going to act as general contractor. They're going to get the plumber and the electrician and all of that work, and that comes sort of with one price typically. Or there is an option for certain clients to act as a general contractor, and the clients themselves, are going to find each of the pieces. They're going to get all the quotes. They're going to get quotes for trusses. They're going to get quotes for windows and doors. They're going to find a plumber and an electrician. The lender does expect that if you are going to act as general contractor, you have some degree of experience in that field.
I didn't know that.
Yes. They want to know that you sort of have an idea, either having built homes previously or have an idea. And part of the way they judge that is how thorough your budget and or quote are up front. Yep. So in that example, we look at some estimates for what your build is going to look like. And that's when we look at more specific kind of granular financing data. So now you have your lot, how much is it going to cost to build? And that's when we start to get into sort of the more mortgage specifics and what they look like.
Okay. So just going back to what our example. So we bought the house, the lot. We borrowed on. Actually, we didn't end up.
You were ready to.
That was the plan.
You were ready to, but
we were going to borrow 50% in order to secure the lot while we were selling other properties.
Yep.
So I didn't realize at the outset that before we could build a single thing, we needed to have paid off that lot. So these are all important things for people to realize, that you need to own that lot before you can move forward. And having somebody come in to see whether the amount that your general contractor or yourself has planned out and budgeted out, whether that actually is appraising. I guess that's the next part that you were probably going there, but that was another part of it that I didn't. Another step, right?
Yeah.
There's a lot of steps.
There are a lot of steps, and some of them have to happen concurrently.
Right.
So you're kind of doing one step as you're trying to finalize another step. So another thing I'd like to bring up, actually, which I didn't talk about at the start, is some people wonder if they can live in their home while they build, if they have to sell their home. It depends, is the short answer. It depends on their personal finances. If they want to live in their home, they have to qualify to hold both of those mortgages simultaneously, which may or may not be possible depending on the amount of the build, the amount of the equity in their home, their mortgage situation, their income, etc. Some people choose to sell their home and live with family members. Some people choose to sell their home and live in a trailer on the property.
Not naming any names.
Not pointing any fingers. So there's lots of options around that, and each person's situation is different. But to your point, yes, the next part in the process is, so you've owned your lot, you've done your research and got some numbers to your build. Either you've got a contractor or builder who's given you a contract or quote effectively, or you have a spreadsheet and you've gone out and you've filled in that spreadsheet, everything from your building permit, your surveys, your trusses, your windows, etc. So the next step is then to get an appraisal of what the value of your house is estimated to be once it's built. So this is not the same as your typical sort of appraisal. It's more expensive and it does take longer. So the estimate right now is anywhere from sort of $800 to $1,000 to get a full build appraisal. Yeah. And it can take 2 to 3 weeks. In the busy summer months, we had ones as long as 4 to 6 weeks. So depending on when in the season and how busy they are, the appraiser, what they're doing is they go out and see the lot. They take the plans, they take the budget or the contract or the quote and look at what's being put into the house, and they look at comparable properties around the area that look like the home that you're building. What have they sold for? And that's how they come up with sort of an estimated value.
Yeah, and when we had the appraisal done, they asked us questions about what types of countertops, what are you doing for your flooring, so the fit and finishes of the house.
Yep.
That all goes into and actually our appraisal I thought was pretty accurate to what, I mean, it's changed now, of course, because we still haven't built our
Changes
house.
quite rapidly.
Yeah.
But yeah, no, and it tends to be fairly accurate to what they expect to be. But what is important is it's not that you couldn't change any of those finishes ever. It's not that you're so wedded to those. But if you change them, it may reflect in the value. Right? If you said you're going to put in granite countertops and you decide to do laminate, yes, that might change the ultimate value. It's not going to knock it down by hundreds of thousands, but it might change the end value.
Right.
So every time the appraiser goes out through the process, and I'll explain this in a bit, to go and inspect the property, they're comparing the build with the plans and the conversations they've had about what it's going to be. They're looking at that to say, not only are you on track on your build, but are you doing what the plans and what you said you were going to do? Is any of that changed?
Right. Yeah. Okay, so now you've got your lot. You may or may not have paid it off yet, but before you build, you have to. Mm-hmm. You've got your appraisal. And so what's next? So now it's to approval at that point?
At this point, we have real numbers to work with.
Right.
Because up until this point, we sort of had an idea of what the house was going to be worth, but we didn't have a concrete number to base it on. So let's use the example of, $500,000, for example. The house appraises for $500,000. The lender will allow you to borrow up to 80% of that. So that's $400,000. So that is now our maximum mortgage that we can finance. You don't have to do a mortgage for $400,000, but that's your sort of budget on that type of appraisal. And at that point, we start to look at, what the draw process looks like, which we can talk about in a few minutes, and how much cash you have upfront, which is part of the initial assessment we do. It's not just owning the land, having the plans, having all of that, but you need to have resources, be that cash from the sale of your home, cash that you have in savings, ability to borrow to fund any gaps in the interim or overages or delays. And so that's part of what we look at as well. What cash do you have to get yourself started on your build?
Right, so and then that leads into the draw that you talked about. So After you've got, so yep, you can borrow the money. Yep, you're good. The appraisal all works out. You now own your lot. Yes, you can start your build. You want to have that resource so that you can start your build. And so what does that look like?
So there are a variety of options. I'm going to focus on one in particular. There are a variety of options that allow you to take a first draw without doing any work. Some of those options are more expensive or less expensive than others, so they're not necessarily ideal. And most of the time, if you have to take that first draw to start your work, the likelihood is you're going to run out of money through the process. So the ideal is to have enough money to do the following: to pay for your building permit, to do excavation, to do foundations, to do footings and subfloor. If you have enough money to get yourself to that stage with a little extra buffer, then you should be good to not only take your first draw, but have enough from that draw to really get another amount of work done. So I'll back up a step though to tell you what happens to get that draw. So what happens is you do that. You do foundation, footings, excavation, subfloor. The appraiser goes out and they take photos and they inspect. And they're checking to make sure all of that work is done. So for example, if you've just done excavation, the inspector goes out, they're going to say, no, you don't have enough work done, versus what we had said we were going to do for the first draw. So the appraiser then writes up an inspection report. This is between sort of $150 to $200, plus or minus mileage if necessary. And they provide that to the lender to say they're now complete to this portion. The lender then releases what's called the first draw. The first draw is the initial amount of mortgage that they're going to lend to you to get the next bit of work done. So let's use an example of $100,000 as your first draw. Every dollar you get in a construction mortgage, 10% is held back at the lawyer's office. It's called the construction lien holdback. That amount of money is designed if you finish your build and a contractor hasn't been paid, they have the ability to put a lien on the property. So that money is designed to be held at the lawyers until 60 days after you've finished your build and received occupancy to protect against any contractor that hasn't been paid.
Right.
So you do get that money back. It's not a fee, unless you haven't paid your contractors. But it's not a fee or a cost. You do get that money back, but that money is withheld. So when clients think, oh, my build is $400,000, I have a mortgage for $400,000, I should be fine. But the reality is, if you have a mortgage for $400,000, you're only getting $360,000 because $40,000 is going to be held back at the lawyer's office.
Right.
Right. So when
and that can add up. Like
that
can
can
be a
add
big
up,
chunk of money. Yeah.
Right. And then you have legal fees. Your lawyer is going to charge you an upfront legal fee to register the mortgage, same as they would do with any purchase or refinance. But they're also going to charge you every time there's a draw because there's administrative work on their side to do that. The appraiser, as I said, is going to charge you every time they do a draw. So there's all these little bits that we have to account for in that money. That's why you need that extra sort of cash or ability to borrow to cover those gaps.
Right, and you can't just sort of calculate this is how much it's going to cost to do excavation, foundation, subfloor, because like we're in right now, we've already put out a 50% deposit on our windows. We've already put out a 50% deposit on all the cabinetry. Like, so that money is outlaid, but hasn't gone into any of that infrastructure yet. And it doesn't count for anything. Correct. Other than the fact that we just had to have it, and here you go, writing checks.
So when the inspector comes out to do their inspection, they don't look at the lot, see the windows, and go, oh, they've got their windows done. Let's give them credit for the windows. Until those windows are installed. But as you know, and this has been more of an issue through COVID, although not that you didn't have to pay deposits before. But the deposits typically before were 10, 20, maybe 25%, maybe even 30. But now we're seeing deposits of 50%.
Yeah.
In some cases, we're seeing, I know one client that had to pay 100% of their trusses up front.
Yeah.
Because they were backordered for 9 months.
So
to get themselves in the queue, they had to pay upfront for their trusses. So exactly right.
Yeah.
That is why it is so important to kind of have all those numbers and that excess. And it's why I might say to a client who qualifies to hold both mortgages, like their home and their build, you might not want to.
Yeah.
You might want to sell, because the reality is you can qualify, but you're going to struggle. There's going to be times when you're going to struggle.
Right. And as much as I kick myself for selling, just before everything in Kingston went up by about 38%. The stress level is definitely lower, knowing that we have the funds to get us where we need to go before that first draw. Because I would imagine that for a lot of people, they're just like, okay, come on, finish it so we can pull some money to get
They
the next
drain
part done.
investments or savings, or even worse in some cases, they create such a liability or such a debt with the contractor or builder that eventually the contractor or builder says, I can't go forward anymore.
Right.
You're
Right.
so behind on where we need to be. And that creates a strain in the relationship. It doesn't make you a priority with the contractor or builder if they're not getting paid,
Yeah.
when they
I would
expect to
imagine.
be. Yeah. So it's one of the reasons that when I do the first kind of call with the process, I walk through the process. But one of the things I say to the client is, a lot of people think that your land is your 20% down payment. They think that the land is the down payment.
Mm-hmm.
The land is like a bonus. The debt you still need to have. I mean, it's not quite 20%, but it doesn't hurt. Like, you still need to have really a decent amount of cash or ability to borrow. And if you're going to borrow it, that's fine. But how are you repaying it?
Yeah.
Right.
See,
If you need to borrow, in that example I gave of 400,000 with the 40,000 lien holdback. If you need to borrow 40,000 on a line of credit, that's not too bad because you know you're getting the lien holdback back. But I will tell you, probably 90% of my clients who get the lien holdback don't pay back debt with it. There's always something to finish.
Yeah.
It's like, well, we
yeah.
didn't quite get to the deck, or our landscaping, or we wanted to put it. So a lot of times people are using the holdback to finish a few things they didn't get to.
I can see that, especially when you know that everything always goes over what you think it's going to.
Yeah.
You can count on it.
Yeah. So the other thing that I typically do is, if I know my client's build is 400,000, but the property appraises for 800,000, I will encourage them to get a higher mortgage than we think they need.
Right, which is
You are
what you
exactly right.
what we discussed, and
You're
and we're
way
doing.
better off to have more money than you need. And remember that in a construction draw mortgage, you only pay for what you use. So unlike a typical mortgage, you don't take out a $400,000 mortgage and pay interest on it from day one on that 400,000. What happens is they register a mortgage of 400,000. You take your first 100,000. You're paying interest on that 100,000, interest only, monthly. In some cases, they take it out of draws, but let's say interest only monthly with some lenders. The next draw you take is 120,000. Well, you're still paying interest on the last 100. Now you're paying interest on the next. So now you're paying interest on 220. But you're not starting out paying interest on the 400.
It's not right from the very beginning.
And if you don't use the full amount, so you've asked to borrow 400, but you use 350, then we will reset the amount.
Right. And okay, so your first draw is done with subfloor foundation, but you can do more if you want to.
Sure.
If you wanted to, if you got the cash flow and the money to do it, you can delay that first draw till maybe it's enclosed or something like that. What would be the normal sort of second draw? Like what are you looking? What type of completion are you looking to have for that?
So typically, I mean, it depends on the client. As you said, some clients get to sometimes get enclosed before they take their first draw. Right. Some clients have got rough-ins, a frame or whatever. So if the client has taken their first draw at subfloor, and the next draw could be basically framing, rough-ins, getting the trusses in, and then they take their next draw. It kind of depends on their cash flow.
Right.
What I say to clients is, don't exhaust your resources before you ask for the draw.
Right. Because it takes a bit of time.
Yes. Well, it takes a bit of time, and I always say, always keep. There's always a minimum amount of money I want them to keep sort of aside, because somebody else comes to you and says, I need a deposit, and you've exhausted your resources and waiting for a draw, and you know that draw is going to other things. So typically I tell clients, don't exhaust your resources, and second is, always ask me like 2 weeks before you need the draw. So if you think you need the draw on July 15th, come to me by the end of June and say, you've got a draw upcoming.
Okay.
So we can plan ahead. Because remember that from the moment you ask for the draw, I'm ordering the inspection. The appraiser's got to go out, physically visit the site, come back and write a report.
Mm-hmm.
The lender has to review that report. They sign off on the report. They send a note to the lawyer. The lawyer releases the funds.
Right. So it's a process.
Yes.
So typically, how many draws do people do? 4 throughout?
I would say probably an average is about 4.
Okay.
Lowest I've had is 3. Most I've had, I think, is 8 maybe.
Oh wow.
You don't want to do a lot of draws, ideally.
Right.
If you have
just
to,
a
you
lot
have
of
to.
stuff.
It's a lot of administration. It's a lot of cost.
Yeah.
Some of the lenders will say they have a maximum amount of draws. The reality is most lenders are fairly reasonable with allowing more draws if you need it. They're just trying to discourage clients from doing too many because, as you say, it's arduous.
And so you get to the point where your house is complete and you've done all your draws, the house is done, the contractor is paid. What happens then to you've taken all these, and it's, it's a construction mortgage.
Mm-hmm.
So does it then flip over into, your standard mortgage that
Mm-hmm.
you, is it generally with the same lender? Like how does it transition from
Great question.
the end of that?
So there's two options. The option that tends to be sort of lower rate is you do it all with one lender, and it naturally moves from a construction mortgage into the normal mortgage. So you have a period of time to complete your construction. It says 9 months. The reality is none of my builds during COVID have hit 9 months. Not one.
Like under 9 months?
Yes.
Okay.
I know.
Don't.
I know, it just makes me laugh. So they're not unreasonable. Okay, if your build is still going on after 3 years, they're going to flip you to
Right.
sort of monthly payments and put you on a standard mortgage at that point. So there is a time at which they have the right to start asking you to make principal repayments.
Right.
They're not going to call the mortgage, okay, in that 3-year example maybe. But other than that, they're not going to call the mortgage or make you pay it back. What they're going to say is, okay, it's been 2 years, you're still building, you've been paying interest only, but we now want you to move into a principal
Right.
plus interest mortgage.
Right, I forgot that
Yeah.
the interest only.
Yeah.
I knew that, but that's an important
It
point,
is an
that you're
important
only
point, yeah.
paying the interest
Interest,
as you're
right.
going,
Correct.
because otherwise, you're
cash
trying
outlay
to draw
gets ignored.
money, and,
Yes.
and it's going out to that as well. Yeah. Okay.
So, so in that example where you have one lender, you are doing this, it's one mortgage, and then you have a construction phase. Once the construction phase is done, we look at what you've borrowed. So did you borrow the total amount, or did you borrow less than the total amount? And that's what becomes your principal plus interest payment going forward.
Right.
Okay. And so thereafter, it's a pretty normal mortgage, right? Pretty
Right.
normal 3-year, 5-year term, whatever it is, fixed or variable type of mortgage. The other example, which I haven't really got into too much detail, there are more flexible approaches to this, but flexibility comes with cost in fee and in rate. So there are lenders where you just do a construction mortgage. It is solely for the purposes of construction. It's designed to be a 6-month, 9-month mortgage, maybe a 12-month mortgage. And once you are done, you pay that off with a normal, typical mortgage.
With a
Okay.
different lender.
Correct, with a different lender.
Yeah.
So that's another example. We can do those, but as I said, that type of construction mortgage is right for some clients, but it does bear a cost.
Right. So the one that we outlined here is obviously what we're doing, but
Mhm.
it's the one that you would, if you can, you should do.
Yes,
This-
correct.
This is the way you should
Yes.
be going about it. If you have the means, if you are, the cash flow, all of the things align, that's the way that it should go.
Yeah.
Okay. There was another question. I don't know.
One thing I will point out, so when, something I get a lot from clients, when is the house complete? When do you define it as complete?
Okay, that's
So
a good one.
2 things.
I need
One
to know
is-
that actually.
You should know that, yes. So when your appraiser says it is 90, they technically say 97, we usually say 98. 98% complete or above.
Yep.
And you have occupancy.
Okay.
And that's when the clock starts for the purposes of the 60-day holdback return. So if your appraisal says it's complete but you don't have occupancy, the clock isn't started yet for that
Okay.
60-day holdback
Okay.
to be returned to you.
Well, that's good to know. So all of this sounds scary and onerous. If you have someone like you to walk people through it and to explain it, it is initially at first glance complicated. But if it's explained and you look at each part individually, it is really worth it. Well, we don't have a house yet, so we can't really say.
At the start of the build.
But people do it all the time. People
lot.
are buying lots. People are buying, and building their dream homes or, their first homes. It happens all the time. Going through and listening to the process is like, ooh, why do people choose to do that? But it does sound like a lot initially, but it makes sense.
Yeah.
The more you hear and the more you think about the process.
I think the most important thing is having the right person to guide you through the process, because the reality is I am conservative in terms of how I approach it, but I have to be, because I want to make sure, I have not yet had a client in a disastrous situation where they've run out of money and we have no options. Right. So that is at the end of the day, my ultimate goal is to make sure that the client can complete their build, that it was not a horrific process, that they're happy with the home and they're happy with the mortgage.
Right.
And so, yes, we do a lot of work and we talk a lot at the start of the process to make sure everybody understands. I look at the numbers in depth. I ask I mean, the joke is I ask for everything but a blood and stool sample at this point.
That is true.
Yes.
We've supplied a lot. Yeah.
Yeah. Because I want to make sure that I've done the numbers, more conservatively than even I need to make sure that there's going to be enough there. So, I end up talking to construction mortgage clients probably 5 times as much as I would a standard mortgage client, but because they want to be reassured through the process, and there are a lot of questions that come up. Right. And each build is different. Each person's finances are different. So the answer that might be right for you might not be right for someone else.
Right. Oh, which is why there are alternatives.
Correct.
Higher cost alternatives, but okay. I think. Do you think we've covered pretty much everything? Okay. Well,
I think so.
Thank you
You're
very
welcome.
much.
You're very welcome.
It's super informative. You've helped us immensely through this whole process, which is why I wanted you to share with other people what the process is like. So I appreciate it. Thank you.
You're very welcome. You guys have been awesome.
And thanks for watching, and hit the subscribe button, thumbs up, and I will see you next time on LT Talks RE.